The Wall Street ended the week in the green after IT and auto stocks batted for the bulls. A googly, though, came in from the RBI on the unsecured loans. That's what saw the Nifty Bank underperform, ending with cuts of close to around 1%. The mid-caps, well, they were the star performers after the index hit a record high yet again intra-week. Hello and welcome to the Editors Roundtable. This week, we take stock of the earnings season, put the spotlight on exchanges and their performance, and also look at the big event, the big Cricket World Cup finals. I'm Nigel Souza, and joining me, the men in blue, Nimesh as well as Mangalam. Gentlemen, well, the pitch is telling you the picture, right?
Oh, absolutely. Yeah, I just hope that the Ahmedabad pitch is not as green as this one. But even if it is, we have the world's best seamers right now. We are all set to win. But talking about the pitch report, let's talk about the way the market, performed over the last 1 week. We're talking about the World Cup that happens over the weekend itself. But we forget, it was just last Sunday that we were here celebrating Diwali. It was the Muhurat trading session itself. So, for the week, what is the pitch report of the Nifty? We made around 332 runs. It wasn't a bad week, so to say. A century on, Muhurat trading day. The next day, we came back a little groggy-eyed, 82 points down on the Nifty on low volumes. Then after that, there was a holiday. Then the big move that came in globally, 230 points higher on Wednesday. Then the googly, like you said, on Friday today, ended just about 33 points lower. But that wasn't too bad given, the pitch that we were dealing with. Talking about the market itself, all said and done, Nifty ends this week with a gain of almost 1.5%. We have the mid-caps and small-caps doing a lot better. The mid-caps up 2.5%, the small-cap index up almost 4%. The important point, however, is that the baton this time was passed from the banks to the IT space. The IT stocks, the IT index was up 5% this week. The realty index was up around 5% as well. But the banks, they were underperforming. And on Friday, they ended in the red as well for the index itself. The Nifty Bank ending with marginal losses. The top gainers this time, you keep talking about two-wheelers. The two-wheelers were in top gear. Eicher Motors up 9% this week. Hero MotoCorp up 7%. We had decent gains coming by for TVS and Bajaj Auto as well. Among the losers, it was the financials. Understandably, we had Axis Bank, Bajaj Fin, SBI, ICICI Bank, all of them not doing too well. But in that too, there were a couple of outliers. Indiabulls Housing Finance, out of nowhere, up 14% this week, at a time financials which were not doing well. Then you had Manappuram up 14% as well. Good results coming in and good commentary after that. PFC, REC, they have been on a tear of their own. And Coforge, we speak about IT stocks, mid-cap IT is doing well as well, up 10% this week. But then, big gainers coming in the small cap index. So we had Veranda, which was up 32%. And just this week, last 4 trading sessions, Titagar, which has already rallied over 300% this year, was up 25%. And BSE, you will be talking about exchanges, but 20% after a big move already. Now the big question, what are we looking at in terms of the next week? I just have 3 big questions. One, are there further legs to the global rally? Will we see further, up moves out there? The answer to that will be, will there be further fall in the US bond yields? The US bond yields from 5% plus have corrected closer to 40 basis points. Does that continue? And finally, from a bank Nifty standpoint or financial standpoint, has today's move discounted all the weakness that came in from the RBI or not? And do we see a fresh start next week or not? So that's the pitch report.
All right, so that's about the pitch report. But Nimesh, what's happening in terms of dealing room action?
Nigel, as even Mangalam pointed out, we rallied pretty hard this week, and that was largely because of the global cues, right? It was a global risk on, which helped Indian markets as well. I think the 3 big headwinds for the market have turned positive in this week. The crude has fallen, the 10-year yield has fallen, as well as the dollar index has fallen. So all 3 were seen to be positive, and that's helped the Indian market, so to speak. But while Mangalam spoke about a lot of winners and all, to me the biggest winners and consistent winners has been the PSU stocks. Yeah. Even this week, there is a clear leadership now for the PSU stocks to outperform. So that is clearly playing out. The good part is the Q2 earnings season was not bad, right? Yes. It ended on a very strong note. There were some fears that the last leg of the earnings may disappoint, and that could be a bit of a concern, but that's not been the case. So earnings has been supportive. The only thing to watch from here would be the FII flows. And I was just looking at some data. The FII positioning in India is at a 5-year low. Okay, so they have, and the markets have been at nearly all-time high. So the sense I'm getting is, if the state election outcome is positive, you might see a big gush of money coming back into the Indian market. So I guess when I talk to a lot of global clients and larger sell-side people, they do keep telling me that the FIs is just waiting on the sidelines to pour in. So the domestic liquidity is very strong, that we all know. if the FIs join the party, you will see a big rally in the large cap names. So that's the overall feedback. But I guess at the margin, what we saw in this week's rally was largely on back of the global risk on turning positive for Indian markets.
Okay, all right. Gentlemen, thanks a lot for that. Well, let's welcome Ajay Srivastava, CEO of Dimensions Corporate Finance Services, as well on the show. Hi, Ajay. Good to see you in. I'm unsure. Last time you told me why you're not heading to see the match in Ahmedabad, so we'll talk about that a little bit later. But tell us about market setup. How are you feeling? We had a bit of a shocker, a bit of a googly, so to say, from the RBI on the banking names. But otherwise, how are you feeling about Indian equities?
I think Indian equities are doing well. And the only challenge is that for Indian equity investor is that, are you buying enough of the winners? I think, the old strategy of trying to broad-base investment, I think is not working. You need to back your guts, back your analysis, and back the winners. So for every 2 or 3 shares you see going up, there are 4 or 5 laggards in the system at this point of time. So I think fundamentally now you have to focus your mind on what the themes are and put concentrated bets on this. Spread out the risk is not working out. The large cap story is obviously not working out for any investor at this point of time. The banking, you already spoke about it, Nigel. It's not going to work out if we have been talking about it. It's a very competitive industry at this point of time. It's notwithstanding what RBI has done. Irrespective of that, the results have been showing the slackening of the banking industry in the last quarter or so. So I think by and large, select sectors moving up, but on the other side, lots and lots of irrational exuberance. Companies not doing well, share price going up, P expansion on the rampant. So I think this is a time that I said, you need to be careful where you're investing. If you know what you're doing, you've got to put your bets in. If you're trying to buy everything under the sun, which is going up by 4%, I think you'll come to grief because more than half the stocks are way, way beyond anything fundamentally they should be valued at.
Hi, Ajay. You spoke about backing the winners. The big winners in the last few months has been the PSU stocks. And within PSUs, today was a day when the rail PSUs did well. What's your sense on the overall PSU basket and anything that you're liking and you're betting on at this point in time?
Not only rail PSUs, rail stocks have done first time best in last 25 years. I can promise you lots of us have bought number of times the rail stocks before the rail budget and sold after the rail budget. Okay, I think for the first time, we are seeing continued traction in railway private stocks more than anything else than in for the PSU stock. So I think rail as a story is unfolding at this point of time. The magnitudes could be way, way beyond we have even imagined because they are talking of hundreds and crores of orders. So I think the rail story is there for some time to come. It's not going to end in overnight. Now, how we respond to the share price, different matter, but the story is real at this point of time. PSUs, it's really still undervalued. You pick up any PSU stock, way, way undervalued compared to fundamental. Now, what you do with them is a different matter. Whether you keep them for dividends, you keep them for growth, you add and average them, whatever you do. Fact remains, they are among the cheapest bunch of stocks today. Lots of them have flattered to deceive in the past, but I think, in a market which is so surcharged with P's of 40s and 50s, when you get P's in single digits, I don't think you can go much wrong in them. You may take time to get a return out of it, but I think PSU as a bunch of stocks represents tremendous value over time. And, once we are out of the elections, hopefully there'll be some divestment or something, movement happens in the companies. But at the end of the day, you're not buying expensive. And I think if you're not buying expensive, and a lot of them are monopoly stocks. Monopoly stock, not expensive. Government owned is a bit of a dampener. You don't go and buy in PSU stock. The only one which you'll not recommend to buy is the refining companies because there are no more PSU companies. They are PA departments at this point of time. So leave aside the refining companies, which are, whatever. There's no way to estimate what they'll do. Other bunch, phenomenal value for money.
Perfect. I mean, PSUs, we will most definitely keep an eye out on that forever, the trade before elections. And like you spoke about, the railway stocks earlier, they would be buzzing before the railway budget.
But now there's no railway budget, right?
There is no railway budget. And before Titagarh Wagon actually, or now Titagarh Rail Systems as they call, actually started to rally, it was an underperformer, the same price for the last 10 years. I was just looking at the data.
So a lot of those railway stocks have done this.
A lot of them are making money. But he spoke about, single-digit PEs, the valuations, etc. Talking about E of the P, that's the earnings season. That was upon us, Nigel. You did an analysis of the report card. How did that look?
So let me go across to the big wall, actually, and give you an analysis in terms of how did the earnings scorecard look like for the past quarter itself. So just taking stock out there, the broad consensus is no worries with regard to the Nifty EPS and the earnings out there. Maybe some concerns coming on in terms of the broader market. So the consensus basically has been maintained. If you're looking at the forward earnings, well, it's revised by close to under % for Motilal Oswal. And Nuvama, they have put in some numbers out there. They say that, in fact, the growth that they're looking at is 15 to 16% for this year. That's this fiscal. It compares with around 10% in the last fiscal. And they're saying that, in the first half of the year, we have grown by more than 20%. So that means the asking run rate for the second half of the year is only 8 to 10%. So no worries with regard to FY24. The question is, will the 15% forecast for FY25 be a little bit too optimistic? So that needs to be answered, because they're highlighting a couple of headwinds that could emerge. Maybe the best of margins are going behind us and consumption is slowing down a little bit. Now, the broad consensus, though, with regard to the earnings on the whole, Jefferies, they say that they've cut earnings estimates for 51% of the 150 companies. And that's the highest number in terms of earnings cuts that they've seen in the last 7 quarters or so. Motilal Oswal, they say they're tracking on 240 companies. And in terms of beats and misses, well, there were more number of stocks that beat their estimates. Misses were far less, and inline was close to around 80 companies odd. The problem is, from the broader markets, the BSE 500 companies, will there be an earnings miss from here on? Because the top line grew by only around 5%, but the PAT surged by around 25%. If you look at PAT margins, the expansion was to the tune of close to around 400 basis points to around 13%. And this was very, very strong. So that's a question mark whether or not this can sustain out there. Input costs were lower, and that's one of the reasons why profitability looked good. And with lower input cost, you had operating cash flows as well that looked quite good. Because the working capital requirements did fall down. They're highlighting, though, that the cash flows have improved this time around, so no worries in terms of the capex so far. But the problem is, you have the small and the mid-cap companies where their earnings are a little bit more cyclical in comparison to the large-cap names, and that could put some pressure out there. So they're saying that it's a good showing, but is it sustainable? The superior margins, they drove earnings to outperform in the past quarter in comparison to the large caps. But there is a bit of a question mark in terms of the earnings estimates going ahead. And finally, they're saying that, the wage bill as well, the growth out there was only around 11%. And at some point of time, this low growth in the wage growth, that's what could hurt consumption as well. With the slowdown that we've seen in the export market, there are signs of slowdown as well. So will this lower wage growth hurt? So put it all together, the Nifty EPS, fairly good. No worries in this year. Will there be a question mark for the following year? And broader market earnings momentum, can it sustain? But let's get in Ajay's view on this. Ajay, what's your take? That the Nifty EPS, it should grow by that mid-teens odd. But the broader markets, the PAT margins are growing, but the top line is not growing. How do you analyze this?
I think absolutely correct. There is a demand slowdown in the economy very clearly, and it is manifesting across most sectors, except engineering, I would say, is one sector which has not seen such a demand slowdown, which has done well at the point of time. But, in each industry, while the demand has slowed down, you find that there is a winner sitting there and who has done well. And I give you example, for instance, look at agrochemicals. You have a disaster result from UPL. You have a superlative results from PI Industries. So I think, I would recommend you, Nigel, to investors this. Don't worry too much about the economy. It's too big for you to visualize. Just focus and see where your company lies. If your company, your investee company has not done well in this quarter, and on the top line definitely done badly, I think it's a caution signal out there because demand is not improving in the economy. So my view is that I don't know where economy is going to go. What's the average PE? I don't know, because I look at my stocks, my investment, and I'm surely looking at the fact that there is a demand slowdown. So you need to pick out winners within the demand slowdown. And whether it is your chemical industries, which has got a huge slowdown in demand, or you look at other industries, that is one. Number two is, these indices are past. You need to look at companies of the future. And that's important. That is your portfolio now represented by more newer companies coming into the market. You see the number of IPOs. And I would say, look at a portfolio and say 50, 60% of the portfolio should be companies which have come up in the market in the last 3 years. Then only you are representative of what the economy will look like 3 years from now. If you are going to base your portfolio on what our companies have been last 10, 20 years, I think you're going to get very poor performance. So our recommendation is forget the economy, forget the index, look at new age companies, new themes coming to the market, build your portfolio around that. Some of the older sectors may do whatever they have to do, but I think they give a pass. Don't waste money on cement. Don't waste money on steel. There are so many new companies and themes in the market today. Focus on them. They will give a better return. So forget the index, forget the EPS, forget the PE of the Sensex. Those should not bother you, because how many of those Nifty stocks do you actually own in your portfolio? May not be very many for most people. So if you don't own them, why worry about them? Generally speaking, new theme, new age, and winners in each industry are going to outperform no matter what happens. So don't get worried about demand slowdown. Demand is slowing, and that's given for you in the economy, which is why I said all the more reason, pick out the winners and back them. By broad basing, you're not helping yourself because 1 out of 5 companies is a winner, 4 will be a laggard. So if you're in those all 5, your portfolio is done for. If you're in only 4 and miss the 1, you are really in the shitscape. So I think focus on the company. If it's not done well in September quarter, I think it's a clear candidate to look at why you're holding it.
All right. You said that you looked only at your companies during this result season and compared to what others in the sector and the market were reporting. Did you make any changes to your portfolio basis this result? Did you add anything? Did you reduce anything from your portfolio?
None. Absolutely same theme continues, and we've added up to exactly the same themes. No, I don't think we have gone back into NBFCs. We've not gone back into banks, which are totally out of our portfolio, maybe 6 to 9 months back. I don't think we have picked up any large cap at this point of time. So I think by and large, the theme remains same. Focused, niche, new age companies have become predominant part of our portfolio at this point of time. And capital goods, of course, is the biggest chunk at this point of time. So we have got capital goods, so we got hotels, we got new age companies, we got teams in the market which don't represent. There's a company which operates lounges, there's a company which the payment system, there's a company, So I'm just saying that nothing needs to change your portfolio. It is going true to form. Newer companies, more hungrier companies who are doing well are still doing better. Laggards are going backward. You've seen the railway story, it just continues. Defense, it's going to be a 5, 10, 20-year story. So you don't need to tweak your portfolio choices for a quarter based upon what's going to happen. I think the stories remain the same, theme remains the same. The old age companies, I think, are out, and I don't think they'll make a comeback to our portfolios.
All right. Thanks a lot for joining in. Wish you a happy weekend, Ajay. But I hope that you do, catch glimpses of the game. You've said that you don't watch a lot of sport, etc. But this time around, we hope that you cheer for India and we emerge winners as well. But talking about emerging winners, what's actually emerged the biggest winner this time around are the exchanges itself. They say the house always wins. Yeah. Nimesh, you've been talking ad nauseum about how exchanges have strong fundamentals behind them. True. Is there more to go?
Looks like there's more to go, and I'll say this because there's still a lot of disbelief, and there are structural changes which has led to this big outperformance. Sometimes people just look at the stock is of 3x and 4x and they fear. But there are fundamental changes happening. There is an earnings upgrade which is happening for BSE, and that's the reason why it's been the best performing stock of this year. So let me just run through, because I've done this piece in early October, and I'd said in the month of October there are a few triggers to watch out for, and they've absolutely played out that way. For BSE, this since October itself the stock is up 86%. Okay, MCX since October 1st the stock is up 40%. And IEX, which has been a laggard in that pack, is up 4.5%. I'll come to individual reasons for all of them. The first is BSE. If you look at BSE, why the stock has rallied so hard, and even since October, why the stock has moved up. The first big trigger was the derivatives volume picking up, and now they've launched the BSE Sensex future as well. So that's going to further add to the earnings going forward, and all the fact that there is going to be pricing, pricing stability as well as and when the volumes improve. And they've actually announced the price hike, which is 5x more than what they were charging earlier. So clearly, BSE is rallying on the back of large earnings upgrade, which is yet to come as well. But now a word on valuations as well. After the big move in BSE, the stock is now trading at close to 47 times on FY25 estimated price to earnings, right? So valuation, a bit of concern, but there is massive growth ahead, and that's why it's been an outperformer. The second stock is MCX. Why MCX rallied pretty hard since October 1st? The key reason was a shift to the new platform, which was a TCS platform. That is now stabilized. We've hardly seen too much of disruption there. The fact that there were a lot of concerns about competition, that's also weighing as well. So again, that is something which is not going to come so soon. In terms of valuations now, after a big up move, the stock is now trading at close to 36 times on an FY25 estimated price to earnings. So valuation-wise, it's captured a large part of it, but the momentum can continue in MCX as well. Now the third one is IEX, and I want to focus more on IEX because that's been a rank underperformer in the exchange platform space, and there are reasons for it, right? There were regulatory overhangs because of which the stock was not doing good. Remember, there was a strategic seller as well. Dalmia Bharat owns a large chunk. They're still, after selling 4.5% last quarter, they own nearly 8% stake, so that overhang will continue. But for IEX, there are a few important triggers to watch out for. It looks to me that the negatives are in the price now. Any positive surprises can see a big re-rating, and those could be, there could be market coupling, that could be a reason to watch out for. There could be some clarity on MBD as well. So that's a big trigger to watch out for. In terms of valuations, relatively compared to the other exchanges, relatively cheaper at close to 31 times on FY25 estimated price to earnings. So while there has been a big move in MCX and BSE, largely because of the fundamental reasons, watch out for IEX as well going forward.
All right, and I wonder, if NSE comes to list, what happens, or if and when it does.
If and when they come to list. Because right now they're quoting at discount to both
Absolutely.
BSE and MCX.
21, 22 times,
absolutely,
in the unlisted market. But thanks a lot for that, Nimesh. You had highlighted it earlier, and I've done a quick revision on that front as well. But time to slip into a short break. When you come back, we'll go full tilt on cricket. India is gearing up for the World Cup finals. Are you ready? Well, we'll be back and we get some analysis on India versus Australia's final match.